is Natalie Hemmens, your favorite Southern California realtor. Today, I am here to talk to you about getting a loan for your home. My special guest today is Beny who is a loan consultant with New American Funding. Beny and I have worked together multiple times to help our clients get a mortgage for their home. Beny, welcome.
Hi, thank you so much for having me.
Thanks for being here. So, a lot of people will go right to the pre-approval process when they're looking for a loan, but I do think it's important that we talk about some things that you can do before you even go to get a loan. For example, like getting your credit checked and updating
Mm,
it if there's anything wrong with it. Can we talk a little bit
mm.
about some things you can do before you even get pre-approved for a loan?
Yeah, I mean, credit is such an integral piece in getting financing, right? You're applying for the loan, and the lender wants to know that you've been able to maintain your credit in a satisfactory way in the past, right? Because now we're eventually going to, potentially lend you hundreds of thousands of dollars. So, credit is a key component. One hint that I have, and I use this myself, is I use Credit Karma to monitor my credit. I think it's a good way. It's free. It's a good way to know who's running your credit, what your credit profile looks like. So I would start with that immediately. But I'll give you a couple tips today that I think are so important that a lot of people don't know when it comes to getting credit. One of those is most people will go into this process to buy a house thinking that they need to pay everything off or get all their debt down.
Mhm.
Having debt and making your payments on time is what's creating your score and making your score increase, right? So having debt is okay, right? Generally speaking. One of those things is when you pay off a credit card and it's all done and you don't want to use it anymore, most people will call up the credit card company and tell them they want to close out the card.
Yeah.
Closing out the card is something that you don't want to do. And the reason for that is, think about it. You've had this card for X amount of years. You've been making your payments on time, which is creating your credit score and making it go up. When you close the card, you're eliminating all of those years of payments being made on time.
Yeah, you're
So in fact, closing a card can impact your credit score and make it drop, which
that's a
most
really
people
good.
don't know. So what you want to do is pay the card off, which is great. Literally cut it up with scissors and just don't use the card anymore. So that's one hint with credit is you never want to close out a credit card. Did
Well,
you know
that's
that?
really, you know what? I have learned that the hard way over the years because, you have a credit card for a long time and you bought a
Mm-hmm.
bed or something and you're like, why
Mm-hmm.
do I need that one? So that one's understandable. But yeah, the longer ones, you definitely want to keep that history. So,
Yes. So one more for you is with
sure.
collections.
Mm,
Medical collections are the most common that we see from this end. So again, you're going into the mindset of trying to buy a house. You might know that you have a past collection on there. It could have been a cable box that you never turned in on a rental that you had,
right.
right? So we all have those. So with the collection, depending on the origin of that collection, most of those collections from a lending perspective, we don't require you to pay those off.
Mm,
So what happens is if you have a collection on there, let's say it was 4 years ago, right? It will stand your credit for roughly about 7 years. So you're 4 years into the seven. You know that you have a $30 old cable box that you never turned in. You think about you're going to buy a house. You know what? I know I have this collection. I'm just going to pay that off and just get it over with. What's happening is when you pay that collection, you're going to start that 7 years all over again. So it's going to stay on your credit. It's going to start that timing over again. And the reason for that is you went to collection 4 years ago. Now you pay it. So it's a double whammy. Now you're admitting that that collection is yours by paying it.
mhm.
So then the 7 years is starting over again. So paying a collection actually could hurt your score, not improve it. So when you're going into buying a house, I suggest talking with your loan consultant. Let them run your credit. They will advise you on what you need to do with your collections. And I bet most of them are going to say, don't do anything with it.
That is one that I have not heard before. So
Right.
that is a really good tip. So Beny, why don't you walk us through, you've checked your credit, you've done some things to get yourself ready for getting a loan, and now you have to go
Mhm.
through the pre-approval process. Can you tell us what that looks like?
Yeah, my approach to this is very educational, especially for a first-time home buyer. I feel that if you can equip yourself with the knowledge of what a lender is looking for in this process, right? So it's not just, what is the max that I qualify for? There's so much that goes into your mortgage. So we're going to be running your credit. We're going to be looking at your income. We're going to be looking at your bank statements, a really thorough analysis. And in that process, educating you on why we're going through all these steps. Mm-hmm. Ultimately, the goal to buying is payment comfortability. And that's the piece that I push more than everything, right? Not, what is the max that I qualify for? The mindset should be, what is the payment going to look like, including property taxes and insurance and things as a renter you've never had to pay for before. Once you can wrap your head around what that recipe looks like for you, and the pre-approval is a very custom approach, right? We all have different financials and jobs and credit and income. So this approach, really, we narrow down what that perfect recipe is for you. And then when all that makes sense and everything looks good and you're ready to go, at that point, you could start looking for a home with confidence. So that's the process of a pre-approval.
That sounds really good. And I think that's a really important point, to make sure that people aren't overextending themselves when they're looking at buying a home, and they're still in a comfortable place where they can buy food and, go out to eat and do some things that they were doing before, and it doesn't change their life way, way too much. Awesome. So you touched on this for a second. You said when you're going through the pre-approval process that you're going to look at bank statements and the credit, and what other kinds of documents should someone have handy when they're going into the pre-approval process?
It depends on your situation, right? And that's back to that custom approach that we talked about. But generally speaking, if you're an employee or you're a W-2 employee for a company, we're asking for your last couple pay stubs that you've received. We're looking at, and within those pay stubs, how you're paid. Are you paid hourly? Are you paid salary? Do you get overtime? So we're really looking at all the different aspects of your income. We're going to ask for your W-2s typically for the last couple years. And then we'll also ask for your tax returns for the last couple of years. So our analysis is looking through all of those. When it comes to assets, we're looking for anything that is in your name. It could be a 401k, it could be an IRA, checking, savings. You might have a stock portfolio. You might have a life insurance policy where you have like a cash value as part of that. It's called your surrender or cash value. So all of those things that we're looking for. And then ultimately, we're going to be running your credit. We're going to be looking through all of that. But that's the basics to get everything going. Obviously, there's some exceptions to what I just told you about what we'll need. But those are the basics.
The basics. And just one more question, because I feel like some people might have this question. What if you're not a United States citizen? What kind of documents would you look for at that point?
Yeah, so that also is going to vary, right? So you could live in the United States. You could be here as a green card holder. In most loan programs out there, as a green card holder, it's pretty much the same as being a U.S. citizen, which is awesome. So you can come here. You can even be living in the States and be here on a work visa. And there are many lending options for those that are here on work visas. So you do not have to be a citizen to buy here. Obviously, we're going to ask for some of your documentation on how you're here, whether it's a work visa, green card, et cetera. But generally speaking, no matter any of those, there are many options.
Perfect. Thank you for that.
Yeah.
I wanted to talk to you about the rates and the down payment. So if you're going to live in the house, it's going to be owner occupied, and there's rates for that. But if you're going to be an investor and you're just going to own the property and maybe rent it out, there's different down payment requirements and rates for that. Can you talk about the difference between the two?
Yeah, great question. And a big difference, right? From a lending perspective, someone that is buying the house with the intention of renting is a higher risk scenario, right? A lot can happen with having a tenant in there versus you living in there. So typically how it works is if you're buying the home as a primary residence and you're planning on living there, there are a lot of options to buy with a very little down payment. opposed to buying it as an investment property. Again, to mitigate the risk from a lending perspective, a lender wants you to have a little bit more of a down payment, a little more skin in the game, if you want to call it. So typically as a primary residence, you could buy a house with as little as 3% down payment versus as an investment property, it's usually about 20 to 25% down payment. When it comes to interest rates, a primary residence versus a home that's going to be an investment or a rental property for you, figure about 0.5% to 0.75% difference in rate. So if the rate was 3% for an owner occupied, you're looking at in the mid to 3.75% range in today's current market.
For the investor. Perfect.
Yes.
There's a lot of different things that you can look at on your loan statement. And one thing that really comes up is like the points. Can you explain what the points are and how they work?
Yeah. So points have a big misconception on points. Points years and years ago would be how the mortgage consultant that you were talking about were earning their income, so they were charging their client points. Points, all that really means is you have the opportunity as a borrower, right, applying for your loan, to get a lower interest rate than whatever the market rate is. So paying points is another word for buying your rate down. There's a whole calculation to this. Some of the questions that I would ask someone to see if that would make any sense for them would be really how long they see themselves in the home. 1 point represents 1% of the loan amount as a fee that you would pay to get that rate. So for example, if the rate was 3% for 0 points, and you said, Beny, I want to buy my rate down to get a lower rate, what would it cost to get my rate down 1 point? Typically 1 point is about 0.25% lower in interest rate. So the rate would be 2.75%. So you would pay 1% of whatever the loan is. If the loan was $400,000, you would pay $4,000 to get a rate of 2.75%. So I think it's always good to ask your loan consultant what it would look like to pay points, is to see that analysis. The thing that I look for most is how long is it going to take you to recoup what you paid to get that lower rate? If it's 4 years, 5 years, 6 years, whatever that works out being, then you ask yourself, do I see myself in this home that long? And do I see myself potentially refinancing my loan, which is pretty hard to know when you're going into this, if you're going to refinance or not. So you run that math, see how long the recoup period is. And if you feel that you're not going to touch your loan for that amount of years, you could argue that buying your rate down would make sense. Well, I tried to make it as simple as possible. Did that help?
You simplified it. And I think that people are really going to understand what points are now. And if you don't, we're going to put your information below so they can call you and ask you.
I love it.
For a second, let's talk about like FHA loans and how they differ from like a regular conventional loan.
FHA loans were our original mortgages years and years ago. So it's been around the longest. One of the bigger misconceptions about FHA is a loan built for first-time home buyers. And the reason for that is FHA allows you to get into a home with a very low down payment. FHA, and the difference between FHA and conventional is FHA is a little more lenient on credit. So maybe you didn't have the greatest credit history. FHA is not so strict on credit, where conventional loans, the rate is mainly based on what your credit score is. So the lower credit score you have, the higher interest rate you're going to get. So FHA is a great way to get into a home. You don't have to be a first-time home buyer, by the way. Maybe you don't have the greatest credit history, but you have a good job, and you have a little bit of money in the bank to come in with a down payment. FHA would be a great way to get into home ownership. Conventional, typically you need a little bit more of a down payment, usually about 5%. Again, very heavy on credit score, on what rate you get. So really going into the situation, or going back into that pre-approval process that we talked about, weighing all those options out. And that's why I keep saying this is such a custom approach, that everyone is different. FHA could be excellent for one person, but for the other, conventional would be a better route. But both of them have their pros and cons.
And just one more question on that. So do certain residences, because you see sometimes when you're looking through properties, it says FHA approved or cash or conventional. So would it kind of minimize the amount of properties that you can maybe purchase if you have an FHA loan?
Great question. Yeah. So FHA will limit you when it comes to buying a condominium or a townhome. Condominium townhomes, in our eyes, are one and the same, right? So the reason is for FHA, or why it could be more challenging, is the association that handles the condominium project, right? The HOA or the homeowners association has to be FHA approved in order for you as a buyer to get FHA financing within that complex. So in a market where maybe we don't have a lot of inventory like we're seeing now, that alone will limit your opportunities that are out there, especially if you're going with FHA financing. So part of this process is, and the strategy of getting you in a position to buy is, maybe we look at not going FHA if you're looking for a condo and do a conventional loan, because it will open up more options that are available to you, where a conventional loan does not need to be approved by anyone. It just has to be a warrantable condo project and you can get financing in there. So it opens up more opportunity to a buyer.
Perfect. I think that's a really good point. And I think that a lot of people don't actually know that. They say FHA, I want to get that loan because like it's for first-time home buyers, they can get a lower rate, and they don't realize some of the repercussions that come with getting that type of loan. So
absolutely.
Filling us in on that. So I wanted to thank you for joining me and for shedding some light on the loan process. It can be a big mystery to a lot of people who have not purchased a home yet. So I thank you for that.
It can. I give you kudos for doing this. It seems like an overwhelming process, but my advice is start this process early, meet with someone. Even if you think you're 6 months or a year away from buying a house, start early, find out your baseline, find out where you stand, and it gives you time to work on whatever you need to work on to be in a position to buy.
Absolutely. Just understanding the process a little bit more, I think, is a huge help to a lot of people, so they don't feel so overwhelmed when they go to buy that house, because that process, it's exciting, but it's definitely a life-changing event in so many ways. So
yes, it should be exciting and fun. So thank you for having me today.
Thanks, Beny, for joining me.